and welcome to our second episode in Your Path to Sell, our video series dedicated to smart strategies for making the most of this critical step in your business's future. Last week, we talked about whether you are truly ready to think about selling your business. Today, we're going to bring that conversation directly to your company and ask, is your business ready to be sold? I'm Richard Frank, Chief Marketing Officer at Capstone Strategic, and I'm joined, as always, by Brian Goodhart, our Director of M&A Advisory Services. Brian brings more than 20 years of experience leading mid-market transactions on both the buy and sell sides. He works closely with clients throughout the deal process to develop actionable strategies that maximize value and support their long-term goals. Brian, like last time, we'll focus our talk on 3 questions our viewers need to be thinking about. So our first question, when we talk about getting a business ready to sell, what does that actually mean inside the business?
So it's certainly a popular question that we get all the time. And business owners say, I'm not sure my business is ready for sale right now. And honestly, readiness is such a large concept that sometimes can be difficult to assess whether your business is at the correct point to be sold. But there are a few things that I would recommend for everyone to do, almost regardless of the size of the business. The first thing I would tell most people to do is clean up your financial statements. So many times business owners may not have financial statements that are of sufficient quality or sufficient depth that could be easily understood by a third party. So you may want to invest some time in really cleaning up your financial statements and working with a qualified team to do so. And in fact, many firms that are getting ready to be sold will actually do what's called a sell-side quality of earnings, which is a sort of an audit that you do or you hire someone to do, where they come in and a third-party firm looks at your financial information, puts together really clean financial records, and proofs all of the things that a potential buyer might want to explore. So a sell-side Q of E is a great way to prepare. In addition, another thing you may want to do is start to assemble the right data and the good historical data for your firm. Oftentimes, people just are busy running their business and they lose sight and lose track of a lot of documents, and they don't realize that they might be important later. So making sure your personnel files are caught up, making sure all of your contracts are up to date, making sure that you have the rights and privileges and titles to all the assets that you employ. Just doing that kind of housekeeping is really, really beneficial. That way, when you get to a transaction and you get to due diligence, you won't have to do all these things in a rushed manner, or they won't be found by a buyer and their counsel. You can address them proactively. So a few things that anybody could do, and that's before you talk to your attorney, because your attorney will probably have all kinds of pre-due diligence that can be helpful as well. There's a few easy things people can do.
What are the biggest gaps that you see when a business looks strong but isn't actually ready for a transaction yet?
So sure. So there are a few areas that I see quite often, and there are a few things that are going to be red flags to virtually any buyer. So as I just mentioned or just alluded to, poorly assembled financial material is almost always a red flag. Now, that doesn't mean a business can't be sold, and sometimes people will view that as an opportunity as they look at ways to capitalize on the kind of inefficiencies that business has. But that's a real stumbling block. And another area where we see it is an overdependence on an owner. And this is very challenging sometimes, to deal with. And this is an unfortunate conversation to have with some business owners because they feel that because their business is of a certain size, or honestly, because they make a certain amount of money, they feel this business is inherently transferable. And that's not actually the case. So one of the things that we need to be cognizant of is that we want to make sure the business is transferable to a third party. So if we have an over-reliance on that business owner, that could really be an impediment to doing so. So just beginning to think about those ideas around transferability, those actually go a really long way in getting you ready.
You mentioned about the incomplete financials or financials that aren't necessarily ready for share, whatever. What kind of example though? What is there a certain thing that is typically missing, or is it just a poorly organized, or
Well,
financials that really? Yeah.
Number of things. So let's be clear. Private companies have wide latitude in how they can prepare their own financials. Generally speaking, we like people to prepare financials along with generally accepted accounting principles or GAAP. But certainly private business owners can prepare their financials however they feel is appropriate for them. But when we're beginning to think about other people looking into those financials, we want to get them into a standard and format that is industry acceptable. And so we want to be aware of those things. In addition, we want to be aware that every business owner, or certainly most business owners, have a lot of personal items that they're running through the business. So, for example, this could be vacations that were paid for by the business. This could be a car that they have, or any number of things that are more aptly described as compensation-like items. And so we need to identify those and kind of start backing those out. In order to do so, it's a great time to think about the business because what we're thinking about is the cash flow that would be available to a disinterested, unrelated third party. And so when we look at a business, private business owners really don't have an incentive to show a lot of net income because they have to pay a lot of taxes. So what they want to do is they want to expense as much as they can through the business. However, when we go to transact, we really want to see that good, robust cash flow. And so we have to make those adjustments to see that. So the more you can begin to identify and think about those things, the more you can prepare for those add backs, the better off you'll be. And in fact, some advisors will tell you that one of the best things you can invest in is invest in taxes, which is just stop doing those things to get your reportable income up. And though you will pay more in taxes, it usually pays for itself because you've got now a cleaner slate going forward.
If someone is planning to sell in the next few years, where should their focus, their time, their energy, what should they be doing right now?
So what should they be doing right now to their business? Is that your question? Yeah.
Yeah,
So I
absolutely.
think again, what I would be thinking about is I'm going to thinking about selling in the next few years. I want to think about that concept of transferability. How easy would it be for another person or entity to come in and understand my business and to then incorporate my business into what they're already doing? And so if you begin to have honest conversations with yourself about that, then you can really find a lot of things you can uncover. And a few of them I've mentioned. So for example, you may see your financials need cleaned up. So you can devote some effort with your financial staff to go in and improve your financial profile. You may find operational things related to that transferability and and the overdependence on the owner. So you could go into your the operational side of your business and say, okay, should I be making some investments here in operations to improve this so this business can be transferred to someone else? Now, we don't have to take this too far, but we do need to begin to identify these things. And one of the great things about working for a transaction is that we transact businesses of all types, sizes, shapes, and profitability levels. So it's completely possible to transition a business in any stage of its life cycle, from its earliest stage to actually bankruptcy. But what we're really trying to do is optimize that business transaction. What can we do to optimize the value we receive for that business? So that's going to be centered around how do we get a coherent story for how this business works, it's where it's been, where it is, and where it's going, and financials and material that match that story. If we can do that, then you're going to be in a really good position.
That is great. Thank you, Brian, as always, for your insights. And thank you to our viewers for joining along. If you're a business owner and selling your company is something that might be on your horizon, let's talk. Reach out to Capstone Strategic on LinkedIn. You can email us at growth@capstonestrategic.com or call us at 703-854-1910. Until next time, thank you for joining us and have a great day.